Hi there, we're going to go ahead and get started here in a moment. My name is Kristen Cooper. I am a certified mortgage planning specialist, certified divorce lending professional, as well as military certified. And today we're going to talk about the housing market. There's so many questions that you're going to have as a buyer and that you should be asking when you're making your decision to purchase a home. And so my goal by the end of this presentation is to provide you with enough value and information that you can make the right decision for you. So thank you so much for joining today. Looking forward to answering your questions. If you have any additional questions outside of what this video covers, please reach out to me. I'd be more than happy to assist you. You're going to have some contact information at the end of this slide that you can write down so that you can reach out to me. So we're going to go ahead and get started here in a moment. Just want to give you a brief overview of my history. So I've been in the mortgage industry since 2002. And like I said, I am a certified mortgage planning specialist, which is different than just your standard lender. So I work more on providing education content, and I have a higher degree that I'm held to standard-wise as well as informational and testing purposes each year. So we're going to go ahead and talk about our objectives today. We're going to look at the top mortgage rate risk factors to watch for in 2018, as well as current trends in the housing supply and demand and affordability. All of those is what's going to trigger the direction that we're going for the mortgage purchase going forward. So first, we're going to talk about something really important that a lot of people don't think to factor in, which is where do mortgages come from and how does that play a factor into the home prices. So we're going to talk about how the money flow works with mortgages. So you have your bond investors, which you're dealing with like Fannie Mae, Freddie Mac, who is the ones that's going to be buying the mortgage-backed securities. And then you have that go to the mortgage company, which is such as prime lending, and then it goes to the borrower. So in order to derive to your rate, it's going to start from what the bond market's doing, how they're purchasing the mortgage-backed securities, and then that filters through to the mortgage company, and then that's how the rate gets passed on to you. So a lot of times you may see that the current mortgage coupon is at a lower rate than what you're being offered, and that's because, of course, when it gets filtered through a mortgage company, they have to add in their margins in order to bring it to you into the market. So you're going to see here, let's say if the borrower pays 5% on their current mortgage, the mortgage company typically takes about 0.5 as their profit. So Fannie Mae keeps about 0.5% as their profit. And then the bond market investor ends up with a yield of return that's around 4%, which is around 1% less than what the borrower is paying on his or her mortgage. So you can see kind of how it filters through what the market's paying versus what is being sold to you as. So this is a chart that's showing the recent fluctuations in mortgage bond prices. Mortgage pricing improves when the market bond prices improve. So mortgage pricing gets worse when the mortgage bond prices get worse. So as you can see, bond prices get considerably worse this year, which caused mortgage pricing to get worse as well. So that's where we see our mortgage interest rates are going up, and that's why on the back end. So we're going to talk about some risk factors. So mortgage risk factor 1 is going to be what the Fed's mortgage bond buying program is. For the past 9 years, the Fed has been the largest buyer of mortgage bond in the market. So as you can see from this chart, the Fed went from holding 0 in mortgage-backed securities in 2008 to holding over $1.75 trillion of mortgage-backed securities currently. In fact, prior to this year, the Fed has previously been absorbing about half of the supply of new mortgage bonds that were coming into the market. So this has had a huge impact of the holding interest rates down to what I would say artificially low levels. Not true. They were just held at artificially low levels because of that. Many economists think that mortgage rates would be at least 1% higher if the Fed wasn't so heavily involved in buying mortgage bonds. That's why I say artificially. So now that the Fed has decided to slow down their purchase of mortgage bonds, mortgage bond prices have declined and mortgage pricing has gotten worse. That's where we're seeing the interest rates go up. This trend is likely to continue as the Fed continues to reduce their bond buying program. So this means that the mortgage rates are likely to continue moving higher continuing through 2008, which they have been. So the Fed has announced that they'll be reducing their purchase of government bonds and mortgage bonds by about $10 billion per quarter. So you can see on this graph how it's declining. So they were buying a certain amount in each quarter. They're reducing how many they're buying. So that artificial rate decrease where rates were staying lower, this is going to significantly have an impact on interest rates increasing as we move forward. Another risk factor that we need to look at is going to be growing federal government debt, so such as increased supply of bonds and increased risk of inflation. The growing risk level of federal government debt will lead to an increased supply of Treasury bonds hitting the market. So the large increase in bond supply will take place simultaneously with the large reduction in bond demand that is resulting from the Fed's tapering program, as we just discussed earlier. So this could have a profound impact on interest rates and bond yields in the months and years ahead. Additionally, the large increase in government debt could fuel renewed fears of inflation. Inflation wouldn't need to take place immediately, though, in order for interest rates to be impacted. Interest rates could react to the perceived threat of inflation if the market becomes concerned that inflation could become an issue down the road. So some things that we need to consider. Mortgage risk number 3, economic growth, such as low employment rate, high consumer confidence, and fiscal stimulus. When there's positive economic news, stocks price tend to improve and interest rates tend to get worse. So it's kind of on a tilt, if you will. It's gonna go up and down, up and down. Recently, we've had many positive economic reports that indicate a very strong jobs market and record high of consumer confidence. Another factor that we need to consider is going to be political risk. The fourth risk, which we're talking about in mortgage rates in 2018, are actually political risk, which could positively or negatively impact interest rates. For example, bond prices and interest rates could improve when there's negative news or concerns about Trump, risk of U.S. government shutdowns, North Korea, Europe, Middle East. Any factor can play a fact into what interest rates do. So really, what we're talking about is interest rates are either going to go up, go down, or stay the same. So we're going to talk about 4 risk factors and how those are going to impact what we believe the market is going to do. It's going to be Federal Reserve tapering program, which we talked about, the growing federal government debt, economic growth, and political risk. Those are all going to play the major factors in what interest rates do, which is going to have a factor on the housing and supply and demand. So now we're going to talk about housing market trends. Housing market risk is going to be supply, demand, and affordability. So we're going to talk about these factors moving forward and how that has an impact to the housing market. So where you can find the information on housing supply and where we gather the information from here is going to be inventory. We get it from the U.S. Census Bureau, National Association of Realtors, and Local Board of Realtors. And new home construction starts from the U.S. Census Bureau and Local Home Builder Association. So you can always look up these information by yourself. It's a lot of information to take in, so I'm hoping to simplify it here, but that's where we get our information. So first we're going to talk about housing supply. Housing inventory has been running at less than 6 months for, quite some time now, as you can see in this graphic. And our market is running around, depending on where we're at with how it's priced, 30 to 60 days if the home is priced correctly. And due to low inventory, prices are still holding pretty strong and are anticipated to hold pretty strong. This makes our topic today especially important because the right mortgage strategy is critical for helping, especially first-time home buyers, not only afford a home in today's market, but win against other competing offers that are out there today. So we're going to talk specifically to Sacramento and Placer County areas right now. This is going to be the data for Sacramento County. Placer County is pretty close to the same numbers, although higher price and values are you're going to be looking at in Placer County. So here's some year-to-date statistics that we can look at for Sacramento County. If you look here, it's going to show a difference in 1 year. So this is from January of 2018 to July 2018. Compared to January 2017 to July 2017. So number of home escrows closed, you're going to see here 10,337, almost identical from last year as far as how many homes are selling, only a 1% change. Now dollar value of closed escrow, you can see here the dollar value, that's a big significant increase. So values have gone up 9.8% since last year, and it shows you the median price of homes, which it shows here gone up 10.3%. So if you look at our graphic here, you can see that the sales volume as well as sales prices are all staying pretty consistent, and inventory levels have gone up, but we're in such a short of demand that we're still seeing prices continue to go up or stay stable in most markets. Now we're going to talk about number of homes listed for sale versus how many are sold, which creates our housing inventory. So you take how many are listed, how many sold, that percentage factors into our percent ratio. Now, if it's less than 6 months, we're considered a seller's market. If it's more than 6 months that property is sitting on the market, it's considered a buyer's market. So you can see here months of inventory. As you slide up the scale and down the scale, it becomes a buyer's market versus a seller's market. So we're going to look at housing starts, which is new, previously or privately owned housing unit starts. Now, we want to look at this illustration here because it's 1 to 4 unit dwellings that are reported to the U.S. Census Bureau. Housing starts are actually a great indicator because it measures how many new housing units will be coming on the market in the next 12 months or so. So many of these units have not even been listed for sale yet because the builders have not completed the construction. So this is more of a forward-looking indicator as to the kind of supply we will be getting in the market in the near future. A healthy number of new housing units is somewhere between 1.5 million unit range, and during the height of the housing boom, you can see here we were building over 2 million units per year. So at the depths of the housing crash, we were only building 500 units per year. And right now you can see we're at just over 1.1 million per year, which is very, very healthy market. So why less construction? Land and regulatory constraints, high cost lumber. Lumber's gone up 47% in the last year. So very, very high cost for building and building permits and the approvals now that are out there. So now we're going to talk about housing demand. This is where we source all of our information if you want to look up some additional information on your side. And we're going to first start talking about unemployment rate. So this chart is showing the U.S. unemployment rate over the past 20 years. During the latest recession, unemployment rate went up dramatically and the housing market suffered as well. So now that the employment rate is very low, people feel more confident about buying homes and housing demand has improved. In fact, employment situation is the strongest it's been in over 20 years. So you can see here that we're looking at 3.9% that we're looking at for the unemployment rate as of July 2018, which is the most updated numbers that we've had. And we're going to talk about job openings. This chart is showing the total job openings in the U.S. It's published in the monthly job openings and labor turnover. The JOLTS report is what we call it. And the report is closely watched by Federal Reserve to determine whether the job growth is increased or decreased in the economy. So many economists feel that this report is more useful than the unemployment rate because the unemployment rate doesn't count all the people that have stopped looking for jobs. So this report, however, looks at it from the employer's perspective and counts the total job openings in the economy. The higher the number, the stronger the economy. And you can see here as you look at the job openings that in the last 20 years, it's the highest that it's been. So in an environment like this, people become very confident when it comes to the home buying process and the housing demand increases, which is why we're seeing such a huge demand on buying homes and the increase in housing demand, which is why we have low supply. So now we're going to talk about consumer sentiment. So it becomes more apparent when we look at the University Michigan report here that in the last few years, consumers have become more confident in spending money and making large purchases like buying a home. So consumer sentiment report reading above 80 is strong, and a reading above 90 is very strong. And we're now seeing the confident number range approaching 100. So we're doing really, really well on consumer confidence, which again strengthens the economy and strengthens the market. So now we're going to talk about home ownership rate. Here in this chart is showing how all the recent housing demand is being reflected in home ownership rate. And the home ownership rate seems to have bottomed around 63%. But now we're seeing, as you can see here, we're looking at about 64.3% based on our current numbers here. And of course, this is for the United States, so I wanted to throw in some factors here from different areas around here. You're going to see Sacramento, Roseville, Arden, we're at 62.9% in homeownership rate. Los Angeles, you could see, is lower here at 48, and then also the other areas here that are pretty lower numbers than the 64%. Because again, the United States, there's many different areas, and we are increasing area here in our area. So I wanted to make sure I gave those numbers here, but you can see very strong still in our rate of homeownership that we're seeing here. This here shows the unemployment rate in California. So all of California, you can see our total unemployment rate is 4.2. So overall in California, we have a very, very strong job market. And the reason that I put this in here is because we have a lot of people that are coming from out of area that are purchasing in our area, a lot of Bay Area. So that has a factor overall as well. The other part that we need to look at is going to be investor activity that has a strong play in the market. It impacts the housing demand because more investors who jump in the market means the more demand is created. And we are seeing, roughly 15 to 20%, which is pretty common in the investor market. So now we're going to talk about housing affordability, which is another factor that plays into being able to purchase a home. So we're going to talk about some different statistics, and this is where you can buy them as well or find them as well. So we're going to talk about the average house price appreciation. Now this is a chart that shows overall house appreciation, and it's still showing a really healthy average of 3.76%. You can see where the market turned here, and that's why it's down, but very strong recovery here. Now you look down here, you can see Placer County, which again follows along suit with Sacramento County. It's a little bit higher, but they're pretty comparable. But you can see here that we show, in the last year, a 6.2 increase change from last year, and a forecast they're saying of another 5% increase, with trending upward as well all the way through 2019. So very, very strong market for home prices, still being stable and appreciating and not showing a decrease in those numbers there. So now let's talk about being able to buy a home versus rent. As you're probably aware or are seeing, rent values have gone up tremendously. So as home prices have gone up, so have rent values. So it's kind of leading alongside. So we ask the question, so does it make sense to rent versus buy? Now, a lot of changes have happened this year with taxes, and a lot of deductions may not be available for some homeowners. So I took out of this factor any type of deduction for taxes, but keep in mind, a lot of people are still qualifying for tax deductions on the home ownership interest deduction. So if that's the case for you, you're going to have even far superior numbers than what you see here. But I wanted just to have a true comparison. So let's say that you were to buy a home at $350,000 versus renting a home for $2,200, which is pretty comparable at a $350,000 range, what you're probably going to be paying for rent. So if we were to go side by side here and just go with the low down payment program, and we take into account, just a factor of only 3% appreciation year over year, which again is well below the annualized numbers that you're looking at for history predictions of what they've been versus what they're going to be. So if we use conservative 3%, you can see here your payment would be roughly $2,012. Now, of course, this depends on what interest rates are at the time that you purchase, qualifying, and not subject to land. Of course, this is just an example, but you'd be looking at about $2,012 versus rent $2,200. So if we take that over and look at extra wealth down the road within the mortgage and versus rent, what you're paying versus what you're gaining. You can see obviously when you rent, you're not gaining any wealth. You're paying your landlord's mortgage for them to gain wealth. But if you were to have purchased, you could see here that you're looking at growing wealth here. That's going to be either an equity principal pay down that you're going to have in your own home here. And then after tax monthly payments, so again, I didn't put any tax benefits here. Of course, some would qualify for that tax benefit and help, but you can still see that sometimes it makes sense that you're going to maybe even pay less depending on, your qualifications and what you're looking at. And the future value of assets, obviously you're not going to have anything from renting, but you're going to have all the equity buildup that you're going to have from owning a home. So it still makes sense right now with rents so high as they are, as well as home prices going up most times, to purchase a home. Now it is case by case. There may be times it doesn't make sense, and that's why you want to make sure that you're talking with a certified mortgage planning specialist such as myself to make sure that you're looking at everything, including your ultimate long-term financial goals, and seeing what's beneficial for you. Then we're going to look at cash versus mortgage. This is another topic, especially for people coming in from the Bay Area. Does it make sense just to pay cash, or should I get a mortgage? And you can see here, no tax bracket again included, even though there are tax advantages for most people. You'll want to look into that. Using a standard rate of appreciation of only 3%. And we look at a home of $400,000 versus getting a mortgage for $200,000 here, and standard interest rates. Again, that's not guaranteed to land. It's just an example, and it's going to be based on qualifying. But you can see here, if using a mortgage versus paying cash. So what you would do is you would invest the additional cash instead of putting it into the mortgage, and that's using an average of a 6% rate of return on your investments and how that would play out. So what you want to do is just look at the ultimate numbers here, and you can see that it would make more sense for you to get a mortgage than it would be to pay cash for the home. So that's another factor that we take into consideration, and especially in this type of market where interest rates really are still relatively low. Based on history, we should be at 7%, and we're still under the 5% mark. So we're doing really good with interest rates, even though home prices have gone up a lot. It's still in the affordability range, and numbers still make sense. With the job market doing good, the economy doing good, with the federal government backing off of tapering and mortgage rates increasing, it still is in a market where supply and demand, the demand is greater than the supply. And based on all the economic indicators, where it's been, where it's going, and how we are right now, that's expected to continue to increase. So you can look at several different economists' statements that all agree that we're still going into an environment where prices are probably going to still continue to appreciate over that normal 3% appreciation rate. And interest rates are expected to go up, slowly tapering up within the next year. I would assume probably see a point higher at the end of next year. But again, that can change daily depending on what's going on with the market. But it is a great time to buy. It is a great time to sell. Depending on what your overall objectives are, you definitely want to speak with someone like myself, a certified mortgage planning specialist. I'd be more than happy to talk with you and run the numbers and see if it makes sense ultimately for what you're trying to do, because everybody's situation is a little bit different. But the good news is we are in a great market, and it's still continuing to improve. It's nothing like it was in the bubble. A lot of questions come through of, are we going to hit another bubble? And I hope that this presentation showed you that no, all of the numbers in the market, the economic indicators, where we are in supply and demand are not anything like they were before. And we're all in almost the majority of loans that have been given over the years are all 30-year mortgages now. The problem was before, people would get a mortgage and it was an adjustable rate. And then when the market turned, not only did they not have the value in their homes, but they were in adjustable rate mortgages. And then that's when the payments would skyrocket to 2 to 4 times what they anticipated it to be. And that's what created the further meltdown. So we've done a great job in the lending and real estate side to make sure that all of those issues are not going to reoccur. And with having most people in 30-year mortgages going forward, that wouldn't happen again. People know exactly what their mortgage is, affordability, and the job market is doing outstanding and continually growing. So it's not the same indicators that were before, completely different path and a healthy, stable market. So if this answers your questions, please give us a call if you have any additional questions. We'd be more than happy to help you. Hope you have a great day, and reach out to me if you have any questions.